Good morning, my name is Przemysław Kwiecień, I'm Chief Economist of the XTB and it's my pleasure to have you on our weekly trading webinar. Today we are going to discuss the latest economic data that was very strong, especially from the US, and we're going to wonder what it means for markets that have been very optimistic, very strong as of late as well. But traditionally, let's start from the top news on Monday morning. So the market is in a very bullish mood right now. As you can see, nothing can change this sentiment, even though we had some negative circumstances over the past 2 weeks that included higher odds of higher taxes, not only in the US but also globally, as Biden administration pushes for global minimum of the corporate taxes. We had higher inflation in China. In US, PPI inflation was 4.2 in March. That was above expectations of 3.8, and that doesn't bode well for incoming months, where we are going to have combination of factors contributing to higher inflation pressures. And we also had China that tries to take advantage of the situation and expand their strategic goals. Despite all of this, the markets remained very buoyant, with S&P 500 storming 4K before Easter and then moving on to continue this rally and easily adding another 100 points with US 100 back at all-time highs, despite all these inflation pressures, thing that could eventually lead to much higher bond yields. This week we are going to have lots of events and speeches, but focus on those three items, or four items actually. That includes US CPI on Tuesday. Like I said, the inflation story is, even though the markets stopped reacting to it, doesn't matter. So going forward, if inflation is higher, then it's going to be a problem. We're going to discuss it in a minute. Then US sales on Thursday, probably very strong report. We have all these Biden checks, we have some reopening, and especially very low base effects from a year ago. So this sales report is probably going to be very strong in US on Thursday, and then on Friday we're going to have housing starts report in US as well, and China Q1 GDP estimate. Okay, so let's move on to the story of the week, economic boom. So basically, right now, there is certainly this race to vaccination, and countries where this vaccination progress is faster, including UK and the US, are reopening faster, and we already can see that this translates into stronger economic conditions in services sector, because in industry, in manufacturing, you can see that actually this positive tendency has been present everywhere. We already discussed this in the past, where people were in a lockdown, and because of all this interventionism and money transfers, and they had actually their financial situation did not deteriorate, so they had to spend money somewhere. Because they couldn't do that in the services sector, they were active in durables, and that obviously that helps industry. So manufacturing PMIs were already doing well, and actually here, even though the US is the highest, when we look at the ISM, you can see that Eurozone actually accelerated faster in the first quarter of this year. So regardless of this vaccination progress, and regardless of overall economic conditions, the industry in industrialized countries has been doing well. Whereas here, what we can see is that in US and UK, where we already had some reopening, services sector is booming. So that suggests that when this progresses in weeks to come, when this vaccination will accelerate, because the supplies will become more become more available and will become more widely available across economies and economic regions, then probably this reopening will intensify and will lead to stronger rebound everywhere in services. So we'll have a kind of economic boom in the months to come. That seems to be, even if you forget about this low base from a year ago where we had very strong lockdowns everywhere, and especially April was dreadful in the global economy. So obviously comparing to April this year, it's going to look much better this year. But even forgetting about this base effect, we're going to have very strong effect from reopening. So those two effects will be very transparent in year to year comparisons. Now the question is, how is this going to impact markets? Because markets were doing great for a long time. They were doing already well in April 2020 because the central banks intervened. Despite very weak data, markets were doing great. Now they continue to do well after the vaccine news in November. You can see a wide variety of indices compared rebased 100 on the day of Pfizer BioNTech vaccine news early in November, and you can see that all the indices actually did very well throughout this period, earning at least 10%, and in case of Russell 2000 in the US, it was around 30%. So the markets were going up regardless. There was weak data, markets were up. Now it's strong data, markets continue to go up. So there are two questions that we need to pose to ourselves right now. First of all, the question is inflation to become a really scare factor? Because as you can see here from the latest set of ISMs in the US, this inflation pressure intensifies. So firms, companies, they want to carry some of their higher costs to consumers. With reopening, with this pent-up demand, with stimulus checks, probably they will be able to do so, at least to some extent. And here's the key. Lately, as you can see, I can show you this on the chart. Here we can see gold prices rebounding from 1680, creating some kind of double bottom here. Here we can see euro dollar also rebounding after a big move downwards, which we discussed for quite a while, and we were saying that the odds were high for this downward move. However, we had this upwards correction. We'll return to this in a minute, but it was all driven by rebounding bond prices, which is here. So obviously bonds are now very important, especially for gold and the forex. Obviously, like I said, the indices, they ignored this for quite a while, and they keep ignoring the risks. But eventually, whatever happens to bonds will also be important for indices. So the question is, why, despite the good, strong economic data, despite inflation pressures, why did we see this rebound here? Well, the first answer is, well, because the market was oversold, like we see here. The decline was strong and there was really no pullback. So you can say technically that was enough to create this small rebound, which then helped gold, indices, and euro dollar. Then again, the other answer is that that I found here is that Treasury, US Treasury, actually they allowed some of their short-term bills to mature, and they didn't roll over them, allowing for higher influx of money into the market. As you can see here, that leads to decline in the cash reserves of the Treasury. So they were able to build these reserves in Q2 of 2020 when the Fed intervened heavily on the markets, and right now they are using this cash pool on stimulus, but they also using this on early bills redemption. And if there is more money everywhere, this money can go to stocks, this money can go to bonds, this money can go to gold. So obviously this helped these markets. However, when you look at the whole year, you can see that the net issuance will be even higher than it was last year, whereas the QE, if maintained at the present level with no tightening, will be much smaller. So there will be a problem because this will vanish very quickly and these big issuances will be in place. So at one point we might be in a situation where the Treasury needs to do something about it, right? Because if they do nothing, and then these bond prices will revert lower and there will be a pressure on all the markets. So I think the Fed realizes this. They are obviously not discussing this openly, but I think they realize this. And there are two options. First of all, they can hope that inflation is more benign than market expects. This so far has not materialized because, as you can see here, these pressures are high, the PPI turn out to be higher, and this reopening is fast, the stimulus is broad, so all stars align for higher inflation. So unless inflation is benign, because if inflation is benign, then they can say, well, look, we can actually expand our QE because inflation remains low and we want to support labor market. But if inflation is actually higher, then ultimately they may tolerate some kind of bigger market correction like the one we had in 2018 where bond yields were on the rise, to say, look, market functioning deteriorated and this is the reason why we want to even further expand our arsenal, maybe using some kind of yield control, right? So be that in mind, because right now it looks great because the bond yields actually stopped and market participants can say, well, everything is fine. But as we can see here, these pools of reserves are evaporating quickly, and at one point it's going to be a problem. All right, let's move on to oil that actually did not enjoy similarly strong circumstances compared to let's say indices. So on the oil market we had very strong rally up to, let's say, early March, and then there was some pullback and demand. Well, there is some kind of demand zone here, slightly above 60 for Brent oil. However, the demand wasn't that doesn't look strong here, so it doesn't look like they could generate some kind of strong rebound and continue the rally, at least for now. The reason is that the OPEC that was very stringent in respecting the limits is starting to relax them. All right, so right now it looks like there will be more oil on the market than what the market expected. There are some shortages expected, especially related to Canada in the months to come. So that's a negative for the market and should be positive for oil prices. However, the OPEC seems to be eager to take advantage of it to pump more of oil on their side, and that supports the view that they are already happy with the price, and then there will be more oil in the longer term. So when we look at oil in charts, it looks like oil will be more dependent on what happens with the euro dollar here. If the dollar continues its momentum and we can see a return here to a downward sequence, which actually could happen about here, because as you can see we are here in a downward move, and there is overbalance structure possibility, at least right now, and also these lows represent a resistance here. So there is a complex of resistances about here. So if we have a return to higher bond yields, then we can see a return to downward trend on the euro dollar, and that could be hard for oil bulls to ignore. And if prices collapse below this support zone, then we can have some materialization of the head and shoulders formation that can be spotted here. Moving on, we have earnings season in the US, which is going to look very strong because we had very weak season. Well, not very weak, because very weak season was in the second quarter of 2020, but already in the first quarter there was some impact of the pandemic and the lockdowns. So obviously in comparison, this season is going to look strong. We're going to start it with financials, especially banks, a lots of results starting from Wednesday. And finally, like I said, a small preview of the data this week. So for sure, we are going to have higher inflation, headline inflation in the US. This is going to be most watched report this week. It's going to be released on Tuesday, 1:30 p.m. BST. So the market already expects a rebound of consumer price inflation above 2%. Actually, the consensus, I think, is already 2.4. So expectations are high, and the reaction is none so far. So while markets are in kind of pink glasses right now, where they do not respond to these risks, it's still very important print. So you should watch it, and you should watch how bonds react to it, because if yields return to this upwards trend, and that means that bond prices are going to continue after this small pickup revert to a downward trend, then it will have strong consequences for gold, euro dollar, and possibly eventually indices as well. And the other reports includes especially retail sales data, which should be very strong, because as you can see already, we can see some hints from banks that credit spending is on the rise, and with this reopening and Biden checks, this report should be strong. So these are the two reports that you should watch carefully among this busy calendar, because there is a lot of releases, there is a lot of speeches, but these two reports could be crucial for bond yields and therefore for broader markets. So thank you for your attention for today. Please stick with us and watch our news section, where we try to report the markets, all the key developments, data releases, technical situation on key markets. So you can watch us from early morning to evening, Monday to Friday, and we see each other next Monday at 7:30 a.m. Have a great week. Bye.